Welcome to Living Your Greatness. Each episode, we bring on great people to inspire you to achieve your greatness. We discuss topics all related to health and wellness. Listen to world-class stories, learn valuable lessons, and turn knowledge into action. It is now time for you to unlock your inner greatness. Welcome back, everyone, to another episode of Living Your Greatness. This is your host, Ben Mummy, and today we have a new guest to the show, and his name is Rick Rule. So for those of you who don't know Rick, he is a highly experienced investor and speculator who has 5 decades of experience in natural resources space. He was a former president and CEO of Sprott Inc. And recently, Rick has retired from the corporate world, but recently started his own educational platform for investors called Rule Investment Media. So Rick, welcome to the show. It is a pleasure to have you with us today.
Pleasure's mine. I should correct that I was president and CEO of Sprott U.S. Holdings rather than the parent company, Sprott Inc.
Thanks for clarifying that. Mm-hmm. So Rick, let's kind of get kicking here. Tell us a little bit about yourself. Where did you spend your formative years growing up? And what inspired you to become a world-class investor and speculator?
I was born in San Jose, California, now known as downtown Silicon Valley. Before it was a technology center, actually, when the chief industry was food machinery. And I grew up in the Bay Area of California. I'm not sure what inspired me to become a natural resources investor, except that at a very early age, I was interested in natural resources. I was interested in biology, geology, forestry, agriculture, all those types of things. And I guess I was about 16 by the time that I decided that rather than being involved in natural resource operations per se, owning a farm and being a farmer as an example, that I wanted to be involved in natural resource investing and finance. The consequence of that, among other things, is that I emigrated from the United States to Canada to attend the University of British Columbia. Really for 3 reasons. I fell in love with Vancouver. I had an aunt there. It was just an amazingly pretty place. At the same time, in 1970, a young American male was probably going to travel, and Vancouver seemed more benign to me than Saigon. But also, the University of British Columbia had a degree program in natural resource finance, which was, as far as I could ascertain, the only one on the North American continent. So I packed up my bags and left sunny California, went to rainy Vancouver. Very, very, very fortunate. My first aspiration in the space was to become a tax lawyer, an international tax lawyer, focused on natural resources and natural resource finance. How an 18-year-old could design that sort of future for himself is beyond my ability to comprehend now. But at any rate, that's what I decided that I wanted to do. And I had the very good fortune of being dissuaded from that by a Canadian tax lawyer who I had come to know, who suggested that while I might be a very good rainmaker as a lawyer, I'd be miserable and that I shouldn't do it. And he suggested, because I had already in university had some success in business, that because I was a good businessman, I would become a good investor. Further, he told me that there was a superb investor in town whom I didn't know, but who knew me, who liked me, and that I should be in touch with this person. That man was Peter Cundall, who was and is one of the deans of value investing. So I met with Mr. Cundall when I was probably 20 years of age, and that brief meeting changed my life. He gave me a copy of the book Intelligent Investor, which I read out of politeness because I wanted to be a tax lawyer. And by the end of the book, I put aside any sense that I would ever be anything other than an investor and a speculator.
Awesome, Rick. Well, thanks for sharing a little bit of a background of your story as well as your formative years. And it just shows you it takes one conversation or one person, right, to make that shift or have that impact. And that's definitely a great book as well by Benjamin Graham. So I'm glad that you read that at such an early age. So Rick, something that I want to shift to, I know then later in your career, right, you actually worked at Sprott. And I'm curious to know, what was it like to work closely with an investor as well as precious metals fanatic like Eric Sprott? Are there any memorable highlights that you'd want to share?
Well, Eric is a spectacular human being. What many people don't know about him is just how nice he is. And so the first thing that I'd like to say is when Sprott bought my businesses, first my lending business, which became Sprott Resource Lending, and then later my money management and asset management business, after the second takeover, which is to say their takeover of the U.S. operations, a bunch of the Canadians came down to California to meet their new staff, and we had them over to dinner at our house. And at one point in time in the evening, I noticed Eric was missing, and I assumed that he had snuck downstairs for a smoke where his wife couldn't catch him. It turned out that Eric had noticed that, my wife was putting on the whole party, and he just decided that she shouldn't have to wash the dishes. So the billionaire who had just bought my business was in my house washing the dishes so that my wife wouldn't have to, which told me an awful lot about who he was. A nice guy, and by the way, a tactical genius. My wife was on his side ever since. And so I would say that's one of my favorite Eric Sprott stories. What I noticed about Eric that I think is common among, sort of eccentric billionaires is that because their decision-making is so rapid and because they're so willing to take risk, that you don't assume that the proper level of empirical process is taking place. What you learn with Eric is that he was brought up in business as a CA, the Canadian equivalent of the US CPA. And he was very, very, very capable of empirical processes. He read and reads annual reports and financial statements, things like that, voraciously. He's done so much empirical work that he can synthesize them and do them intuitively. And I've watched other people. I'm thinking about the now deceased Adolf Lundin and Robert Friedland, who appear to make impetuous decisions, but in fact have engaged in high-level empirical work for so long that they can shortcut some aspects of the process and make what appears to be intuitive decisions that are in fact very, very empirical. The third thing I would say about Eric is he has this wonderful facility with arithmetic that defies psychology, which is to say, Eric will happily take 2 or 3 or 4 50% losses to make a 2,000% gain. What Eric tells you is that the math around speculation, if you have the psychological stability to do it, is such that 1,000 or 2,000% gain amortizes a hell of a lot of 30 or 40 or 50% mistakes and still leaves room left over at the end of the day. Most investors don't have either the psychological or the financial staying power to do what Eric or Doug Casey or other true speculators do. They talk a rough game. Oh yeah, this isn't my first rodeo. I've experienced losses before. And then in a market decline, when things are getting cheaper and they ought to be speculating, they lose their courage, curl up on the couch in fetal conditions and whimper, Eric, when the market fell in the period 2011 to 2015 and wiped out 85% of the AUM that he managed, dusted himself off, reached into savings, doubled down and tripled down, and grew an already spectacular fortune in more spectacular fashion. Very few people have the psychological fortitude to take a whipping like that and come back stronger.
Awesome, Rick. Well, thanks for sharing us a little background, more of that, relationship as well as experience with Eric Sprott. it was cool to hear about, a personal story there. And then it was also really cool to hear about him as an investor and his mindset, like the way he thinks, right? So I really appreciate you for sharing that with our listeners. And I'm sure they enjoyed hearing some of those stories. And this actually moves me, Rick. Last month, I actually met you backstage, at the Vancouver Resource Investment Conference. And I really enjoyed our chats as well as meeting you. The main reason why was I found you were very humble, you were very intelligent, you were very wise, you were funny, and I would actually say you are a young person. Something that I admire about you, Rick, is you advocate a lot about, becoming a lifelong learner. And you yourself, you actually practice what you preach. You have presented at hundreds of resource and investment conferences over the world for the last 30 years. What drives your motivation to help people become not only a better investor, but also a lifelong learner?
Well, I've received substantial non-financial benefit from the process of becoming a lifelong learner. I enjoy it. I love to learn. I'm voracious. And there's no better way in the world to learn than to teach, because teaching codifies your knowledge acquisition like nothing else. If you know something well enough to teach it, you know it better than you knew before you prepared to teach it. So in the first instance, teaching is very selfish because it reinforces in me and gives meaning to the pursuit of knowledge, which is something I enjoy. The second thing is that to not teach, to not mentor, would be extremely disingenuous. When I was a young man, for reasons that I don't entirely understand, I was in effect adopted by a whole series of mentors, Peter Cundall being only one. For some reason, people who were very established in either conventional financial services or natural resources spent an inordinate amount of time showing me the ropes. And to the extent that I didn't take the opportunity to pay that benefit forward, I think I would dishonor my obligation to the many great mentors that helped me early in my career. I can honestly say the mistakes I made were mine, and the mistakes I avoided, they were few, were a consequence of the great lessons that I'd learned from others. But certainly the recovery that I was able to fashion from some of my early mistakes was due both to the psychological mentoring I received, but also the overt encouragement that established people in natural resources and financial services gave to others to give me an economic chance. And to not pass some of those benefits forward, as I say, would be extremely disingenuous.
Awesome, Rick. Thanks for bringing up those points. And it kind of leads me to thinking, although continuous education might not always pay off in the short term, I strongly believe that a well-educated person will always have large benefits in like the long term. And something that I like about education that I've always said is it provides knowledge. And I know something that you've mentioned before, it also cannot be stolen or taxed by anyone. For the benefit of my listeners, what are some of the most influential books that you have read over your life that you think hold great value for investors?
God, the list is so vast. Start with economics in one lesson. That will teach you the way the economy actually works. There's a way the big thinkers would like you to believe it works. It's an easy book to read. So start with economics in one lesson. By the way, don't just buy this book. You don't have to buy it. You can get it at a library, but read it. It's important when I give people books that they don't just pat them and dust them and things, that they actually think about them and read them. The second book we've talked about already, The Intelligent Investor by Ben Graham, is, I suspect, the best investment book ever written relative to the effort required to read and understand it. There's wonderful wisdom there. It's in plain English. And if you apply the lessons that you learn in that book over your lifetime, you will become rich. It's as simple as that. Applying them isn't necessarily simple, but if you pay attention to the very simple lessons in that book, particularly the lessons around moat, durable competitive moat, margin of safety, and Mr. Market, the best chapter on contrarian investing I ever read. If you pay attention to that as a young person and employ your capital in the methods described by Mr. Graham, you will become rich. Not many other books you could say that about. If you enjoyed The Intelligent Investor, then you buy the magnum opus by Ben Graham, which is securities analysis. That's where the rubber meets the road. How to employ the philosophies established in The Intelligent Investor. It is not an easy book to read. It's a wonderful cure for insomnia, frankly. But usually when I'm done reading it, I put it aside and I pick it up and start reading it again, which is to say I never stop reading it because the message there requires discipline in its employment. The most impactful book I ever read, and one that I still refer to constantly, is Human Action by Ludwig von Mises. It talks about the impact of will and recency bias and psychology on individuals, and weaves sort of a fabric of individual responses into a social fabric that talks about the way people act first as individuals and then how they act as groups. And understanding volition, understanding incentive, I think is absolutely critical to understanding the way things work. But more recent books, I would say, include Anti-Fragile by Taleb. And then Taleb's most recent work, which I just got done with, Skin in the Game, I think is a wonderful book for investors. You know, the idea that if you're backing a management team, you shouldn't be backing employees, you should be backing partners. Skin in the game is all about commitment, financial commitment or other forms of commitment. But, you know, that's a tough question to answer because there have been so many books that have helped me so much. Narrowing it down, I tried to give some that would be sort of a primer to a younger person who was interested in a career in investment operations. But there have been, you know, I've also, although I'm not religious, I read both the Old Testament and the New Testament, and I read the Quran, not so much personally for life lessons, but rather to understand the social constructs that those books created. And I would encourage anybody who has the time and the inclination to read the holy books.
Awesome, Rick. Thanks for giving us that list of books, you know, both investing as well as life advice, but more importantly, wisdom. I'm sure a lot of my listeners will really appreciate hearing those names and looking it up. A book that I actually want to share with you, Rick, that had a big impact on my life last year was called The Great Mental Models, Volume 1 by Shane Parrish. And the book shares general thinking concepts that can be applied to both investing and life to help make intelligent decisions. One of the mental models that I've heard you talk about many times that was also mentioned in the book is probabilistic thinking. Mm-hmm. And so from my understanding, this is essentially trying to estimate using some math tools and logic, the likelihood of a specific outcome. It also relates to investing largely estimating like the risk against the reward. So using this mental model, which commodities are you most bullish on for this upcoming year?
There's two different ways to answer that. First of all, I would say that the tighter your time frame, the higher the probability that you're wrong. And so I'm going to answer it in the 1 to 3 year time frame because I don't think that 1 year is the time frame that allows people to understand all of the implications of the subject. By the way, I applaud you, the probabilistic discussion. Most people, before they make a decision, want certainty. And the truth is, I think that certainty is unavailable. And so searching for certainty, I think, is a form of procrastination. It's a way to avoid making a decision. I think you have to make decisions based on probability. So to answer your question and get away from pontificating, my highest degree of certainty still involves uranium. I believe, based on some information from the International Energy Agency, that the total cost of production of uranium worldwide, importantly, including cost of capital and prior year write-downs, which aren't usually included in AISC calculations, are about $60 a pound, while the industry makes uranium for about 50, or sells it, for about $50 a pound. So you make the stuff for 60 and you sell it for 50. You lose $10 a pound, and you do that 120 million times a year. It gets rather boring, never mind expensive. So if the price doesn't go up to the price that the industry requires to earn its cost of capital, the industry self-liquidates, which is why we're producing 120 million pounds a year while we're consuming 200 million pounds a year. But the story gets a little better. Because there's an 80 million pound a year deficit, it isn't merely that we're going to have to maintain current production, we're going to have to increase production. And while the total production costs are in the US $60 range, the incentive cost for new production, including inflation in the supply chain, is probably more like $75 a pound. And so I believe it's absolutely certain that the price of uranium goes to $75 a pound over 3 or 4 or 5 years. I think that's true because despite the fact that, Mr. Biden and Mr. Trudeau and Angela Merkel and Greta Thunberg and all these experts don't like uranium, it produces a substantial part of the world's baseload power. And if the price doesn't go up to a price that allows us to continue to produce it, the lights will go out. It really is that simple. So I have the highest certainty of anything around uranium. Will it happen in a year? I don't know. Will it happen in 5 years? I think it'll overshoot $75 in 5 years. I think for most investors, however, and by the way, I should talk about the risks too in uranium. The real risk is another Chernobyl, 3 Mile Island, Fukushima style thing. If we have another reactor disaster somewhere, that'll set the uranium business back 20 years. It won't derail it because we can't afford to derail it. Despite those accidents, statistically, it's an extraordinarily safe and efficient form of energy. But that would occur over a time frame which would obviate the benefit for most investors. For most investors, I think the commodity that they need to pay the most attention to in the next couple of years is gold. We have a circumstance where the wind is truly in gold sails, and gold and the gold stocks are not responding, which is a wonderful set of circumstance. That circumstance, which is to say the favorable outlook for gold and gold's poor performance, is something that causes people that don't have the courage of their convictions to move away from gold. They're impatient. Mercifully for me, I saw the same circumstance occur in the 1968 to 1973 timeframe and in the 1999 to 2003 timeframe. So I've seen what we have in front of us twice before in my life, which makes me a little more patient. Gold traditionally has done well. I mean, it's done well in periods where there were various types of fear. But the most important fear for gold has always been fear of debasement of the currency and fear of the diminishment of the purchasing power of conventional savings and investment instruments. And I think those fears are realistic right now. While the US dollar is strong, it's strong in the way that Doug Casey suggests, which is to say that it's the prettiest mare at the slaughterhouse. It's strong relative to the Canadian dollar. It's strong relative to the Australian dollar. It's strong relative to the euro. It's strong relative to the yen. It's strong relative to the renminbi, which is to say that all of those currencies are weaker. And the US dollar strength likely continues as they raise the nominal interest rate in the United States. But that's a smokescreen. An investor who was trying to decide whether to be confident or afraid of US dollar related savings and investment products needs to consider a few factors. The first is quantitative easing. Ben, if you did quantitative easing, if you printed mummies, they'd put you in jail, unless you were a member of parliament, in which case it would be policy, and you'd be highly popular. But creating unbacked currency units is, in fact, counterfeiting. Regardless of what you call it, making more of something diminishes the value of the existing stock. More importantly, of course, for investors in dollar-denominated savings instruments is debt and deficits, which compromise credit quality. I don't know the Canadian numbers, but in the United States, we have in excess of $30 trillion in on-balance sheet liabilities. That's 30 with 12 zeros, keeping it company. And probably more importantly, we have $120 trillion in net present value of off-balance sheet liabilities, Social Security, Medicare, Medicaid, all that kind of stuff. There is no way that that's going to get paid off, particularly when the budget, which we propose to use to pay it off, is itself $2 trillion a year in deficit. Rather than paying it off, we're adding to it by $2 trillion a year. That is enough to give any creditor, and that's what a bond buyer is, pause. You will never get your principal back. That's kind of scary. But the worst thing is negative real interest rates. The world's benchmark security, Canadians will hate my saying this, but it's true, is the U.S. 10-year Treasury. It's the deepest and most liquid security market in the world, the one against which all others are priced. And it's a particularly lousy deal. The interest rate on the U.S. 10-year Treasury is now up a little bit above 3%. So you get paid 3% in a currency where the government suggests that your purchasing power is deteriorating at 8.6 or 8.7% compounded. In other words, the U.S. government absolutely positively guarantees that they will reduce your purchasing power by 5% a year compounded for 10 years. It's one of the first promises they ever made me that I believe. But the fact that the premier savings instrument in the world is, to quote Frederick Hayek, a certificate of guaranteed confiscation, means that gold is fighting a war with an instrument that is designed to lose that war. Will it happen this year? I don't know. Will it happen next year? I don't know. But until you have a positive real yield on the U.S. 10-year Treasury, it will happen. And I don't know if we'll have a positive real yield on the U.S. 10-year Treasury in my lifetime.
Question sounds like when, not if, based off of that explanation there for gold. And I know that's something that you use a lot. I know it's helped a lot of investors like myself, think about everything that you just explained. Rick, I want to thank you for, talking about uranium, explaining, the whole thesis there, as well as giving people the caution about what could go wrong as well. I think that's important, always to be fully educated of our risk as well. And the same thing goes for gold, hearing more about thesis and what's kind of coming its way. Something that I want to ask, at Jay Martin's conference, he asked a question on stage before you actually came out on day one. And he said, how did Rick Rule become Rick Rule? Now, I believe your intellectual mind has helped you become the person and the investor you are today. What are some other mental models that you have applied to build a better investor mind?
I'm a hard worker. I show up. And I really like the process. Early on, I competed against people who were arguably smarter than me, but they were in it for the money. I'm not trying to say I don't like the money. I do. But my primary motivation was that I really love the process of investing. Think of it as a multidimensional backgammon game. So for me, it was always fun in addition to everything else. I was about 30 years old when my now wife says to me, forget about the money. Just forget about it. Figure out what it is about the process you love and do more of it, because people will be competing against you who can't compete because they'll be doing it for 6 or 7 or 8 hours a day thinking about something else, and you'll be doing it consciously or unconsciously for 16 hours a day. And the compounding of you working harder and more diligently for years compared to them means that you can't help but win. And she also told me that not to worry about the money, but rather to worry about the product, which is to say you make money by delivering utility to others. And if you worry about delivering utility to others, if the utility that you deliver to them is financial, you will get rich. The surest way in the world to get rich is to make rich people richer. Rich people like money, and they like to pay you if it results in benefit to them. And I would say that within 90 days of my taking that mantra and making it a business plan, focusing on those aspects of my own business that I would do for free if they didn't pay so well, and focusing on delivering utility rather than making money. Within 90 days of that, my income increased substantially. It was amazing how quickly the benefit accrued. I'd say the third thing that I did, and maybe it involves the idea of delivering utility to others, is I was able unconsciously to network even at an early age and become indispensable in particular to people who were highly successful, taught me a lot, and people where my association with them increased the value of my own brand. Adolph Lundin, Chester Miller, later Ross Beatty, Bob Quartermain, Clive Johnson, certainly Seymour Schulich, Ned Goodman. I was able, by the time I was 30, to put in place a group of people that I did business with that I benefited directly, who went on to become superstars in the industry, and who, in the process of having their own careers ascend so dramatically, pulled me along with them. I guess the final thing is, as a capitalist, I like making money, but I don't like spending it. So I never wanted to own a Lamborghini. I never cared much about the material trappings of success. I had occasional aspirations to own a Lamborghini dealership because my buyers were so price insensitive, but I didn't care about the car. In order to be a capitalist, you have to build some capital. And I was a ruthless saver. I frequently save 30 or 35% of my pre-tax income, which is to say I save well over 50% of my post-tax income. And the consequence of that is, at a fairly early age, I was able to stop working for money and make my money work for me. That isn't to say I didn't continue to work very, very, very hard, but I had no particular interest in the material trappings of success. I had a lot of interest in success, financial success per se.
Awesome, Rick. Well, you brought up a lot of really good points in terms of how you think you became where you are today. And I really appreciate hearing, about some of your mentors, that had a big impact on your development there as an investor. And I know you often actually speak about people that have contributed to your wealth, like a world-class mining entrepreneur like Ross Beatty. You've spoken about these people before, right? And so if an investor, is trying to make a decision about finding more people like this, right? Like the real world-class mining entrepreneurs, how could they foster a mindset to spot out the good ones?
That's really easy. The really good ones are passionate. If you go up at an investment conference to an A-leaguer and you ask them a question about their current project, they will talk to you. It's their whole life. They don't give a damn about opera. They don't care about hockey. They're uninvolved in popular culture. You think that you can't approach them and talk to them about their projects, that you can't talk to them about their job, that you can't talk to them about the company. Nothing could be further from the truth. It's the only thing that you can talk to them about. You can't shut them up. And so, first of all, having the jam to just go up and ask the question. If somebody won't talk to you, that's a really, really, really good indication that he or she's not great, that they don't have the passion. When I learned at age 21, 22, and Peter Cundall told me this. Peter Cundall said, a really great business person wants to talk to you about these things. Great business people are usually pretty good salespeople. among other things, that lowers their cost of capital. So they like to talk. But importantly, they like to talk about what they're doing. And if you go up, in my experience, and talk to a really great entrepreneur, he's not going to talk to you about the Canucks. He doesn't care. He might talk to you about politics, but only in the sense that it impacts their business. And as I say, if they won't talk to you, it's a really great indication that they have no passion. I early in my career, you may know this, I was, as an immigrant to Canada, penniless, and I had to work. And so I had to work at night. And so the first thing I did as a young, big 18-year-old who'd spent 10 years as a competitive boxer was I became a bouncer. And I won't bore you with the whole story, but I migrated from being a bouncer to co-owning a bar in Vancouver while still in university. And I had occasion in that bar to meet, among others, Peter Cundall, who became my mentor, but more particularly for this story, Peter Brown, the founder of Canarim, which is now Canaccord. And I would argue the real author of the success of Vancouver as a mining community. I would talk to Peter Brown about business, frequently plying him with alcohol. And what I would do is, pour him a glass of something, and I'd ask him some questions, and then I'd excuse myself, and I'd run in the back, and I had this little 3-ring binder, and I'd write the answers, and I'd come back out sheepishly, and I'd ask him some more questions, and then I'd excuse myself and run back and write down the answers. And I debriefed Peter for months, absolutely for months. And he was extremely generous with that. He liked to drink. He liked to teach. He liked everything about it. I related these stories years later to him, and he looked at me, he started laughing. He says, "You were a big kid with a bad sense of humor. I'm glad I didn't lose you any money." But it just to say that those people who are truly great, in my experience, have wanted to teach.
Yeah, that's huge. I think when they want to teach, when they're, overly passionate, those are qualities where, they live and they breathe it, right? And it really does stand out. And it's funny that you gave that picture there, like being at a conference, seeing all these different companies. There's so many mining companies, especially in like the junior space, right? Which are the more riskier ones, but also more reward if you choose the right ones. And I remember when I was walking around too, especially at BRIC, really, really taking my time, really, really being highly, selective. And almost in my head saying, okay, I'm going to be like Michael Gentile here. I'm going to be looking for that 1% that really, really kind of stands out. And I find it super important before even making that decision process, right? And then obviously in this sector, there's so many other things, to kind of discuss, which I don't think we would have time for today. But the people is a big one, right? And that's kind of why I wanted to bring up a Ross Speedy there to highlight that kind of individual and, unpack that. Something that I want to move to, Rick, is I know yourself, you're a high profile investor, and you also know some other people that are high profile as well. You've also spoken about some of your mentors, but what do you believe separates a good investor from a great investor?
Time. A great investor, well, the normal investor or speculator pays all kinds of attention to the share price, but he or she has no opinions to its value. So they're paying attention to a floating abstraction, which is to say the price. The real investor understands that the first wonder of the investing world is compounding, and compounding takes time. In a junior mining story, what you look at is, first of all, the thesis, and then the proposal by which you test that thesis, the probability of a yes answer, and the value of a yes answer. But it's important to understand that to get real, true speculative returns, 10 to 1, 20 to 1, 30 to 1, you need a series of yes answers. It isn't just one. So the first unanswered question may be that you have a surface gold anomaly, and you want to determine whether that's transported or in situ. And so after doing the soil sampling, you do a trench sample. In other words, does the mineralization extend into bedrock, as an example? And that might take what was otherwise a 150,000 ounce target and make it a 1,000,000 ounce target. And that might take a stock from, let's say, a $5 million market capitalization to a $12 million market capitalization. By the way, with certainty, cheaper at $12 million than it was at $3 or $4 million. The second unanswered question may be the third dimension. In other words, is this superficial enrichment, or does it in fact go to depth? And so, they throw a fence of 6, 7, 8 holes. And then the third question might be, okay, does this blob of rock have sufficient grade somewhere in the blob of rock that the blob of rock can be economic to produce? Now, each of these unanswered questions requires at least one, but probably 2 field seasons to answer, which means that the process of going from a surface anomaly to a reasonably good preliminary economic assessment is probably a 5-year process. The idea that you as a speculator have a time frame that is comfortable for you, which is to say 3 months, in considering the process of answering a series of unanswered questions, which would establish a valuation that takes 5 years, is not the fault of the gold. It's not the fault of the company. It's the fault of the speculator. If the speculator has unrealistic expectations with regards to time, he or she is going to be a failure.
Thanks for giving that very thorough answer. I really appreciate that. And those I would say golden nuggets. Rick, something that I want to move to here, if you could go back and you could give your 18-year-old self one piece of advice, what would it be?
Well, it's a little esoteric. I'm fascinated with risk. I've built my life assessing risk better than other people. Credit decisions and speculative decisions. If I had it to do all over again, I rather than having gone just in the investment business, I would have gone in the insurance business. Probably insurance around natural resources, because underwriting insurance is really risk. You are lending an issuer access to your balance sheet in the event that a risky situation occurs. And the idea that I would be exposed to risk both as an investor and as an underwriter, in other words, that I would expose my capital to both sides of the transaction, intrigues me. I'm doing a substantial amount of that now. I'm doing a substantial amount of insurance business now. And let's just say that having exposure to the subject of risk twice doubles the fun.
Okay, great. Awesome, Rick. Appreciate you for sharing that. Something that I want to move to next, Rick, is, as you know, the purpose of this podcast is to inspire millions of people to achieve greatness and enhance their overall personal well-being. What is your definition of greatness?
I don't have one. Well-being, I do. Being happy with yourself, who you are, and your place in several schemes of things. People define their community maybe improperly. I think that all of us are members of a few communities. And I think, first of all, you have an obligation to choose proactively the communities that you engage with and avoid the communities that are destructive to you. So I think the essence of wealth really is enhancing one's sense of well-being. It might be material wealth. It might be partly material wealth, but probably it mostly isn't. Probably being a part of several communities that you feel valued in, that add value to you, and being involved in a life that you find stimulating and energizing, a life that doesn't drive you to alcohol or heroin, a life that doesn't drive you to escape, but rather a life that embraces and energizes you, I think is important to enhancing one's sense of well-being. Greatness is an odd topic. Were I to pursue greatness in something that didn't appeal to me, greatness for greatness sake, I think, first of all, would probably be unachievable, but it would be a hollow victory, assuming I got there. I'll just leave it there.
Yeah, no, Rick, I appreciate that answer, because I do feel that greatness in general is moment to moment. It's pretty hard to define that, and it can be so different depending on, every individual, right? But I think you did a great job at touching on well-being, and overall wellness, because we could be socially well, but not financially well, right? We could be physically well, but not emotionally well. And it's all interconnected, And I really do feel that for people to be the best versions of themselves, that they need that wellness wheel to be balanced, right? Just like a bicycle, so they can keep moving, they can feel grounded, and they can be themselves and kind of reach their true full potential. So I appreciate you for commenting on that. And Rick, who is a future guest that you would like to see on this show?
Well, there's a guy in your line of work that you might want to talk to. He asks the same sort of questions. Young guy, Jake Ducey, who you might want to talk to. I don't know if you know Jake. Jake, I think, would be amusing. He's impossible to dislike, which is one of the things I've always particularly admired about Jake. But I think he has an interesting take on things. Nobody's coming immediately to mind. If you could get him, I can't. I've tried. Nassim Taleb, I think, is one of the great current thinkers that we're exposed to. I reached out to get him to my conference, and his price tag was deservedly unaffordable. But you might be able to get him in a non-pecuniary role. I'll tell you who you should have. Actually, you could get this guy. The single smartest stockbroker I know, mostly retired now, is a guy named Nash Jiwa with Haywood. Nash he's just simply the smartest stockbroker, all things considered, I ever met. He was a Gujarati Muslim living in Uganda when Idi Amin kicked out all the South Asians. And so he found himself as a penniless immigrant to Canada. I think he came over at age 18, with nothing. All the stuff that the family they had been successful business people in Uganda. All the stuff that they'd had was stolen. They were dispossessed of all of their material wealth. Nash came over, and as a consequence of very hard work, got himself through the University of British Columbia in business. His father had been a businessman, and established himself as a stockbroker and became a very successful stockbroker. And it wasn't, and isn't, Nash is still alive and still active. It wasn't that Nash knew more about finance than anybody on the street, although he's good at finance. It wasn't that he was the best geologist in the place, because he doesn't know very much about geology at all. But Nash knows a lot about people. When I first met Nash, I said, so tell me how your thing works, Nash. I mean, you're really successful. Tell me what you do better than other people. And he said what I said. He said, I don't spend hundreds of hours with balance sheets and spreadsheets and proxies and stuff like that. And I don't even pay too much attention to our analysts who do that kind of thing. And I don't know anything about geology, but I know a lot about people. I am indispensable to Bob Dickinson. I'm indispensable to Robert Friedland. And in 18 months, I'll be indispensable to you too. So that was the first thing. And then there was a gratefulness as I got to know him better. I said, Nash, how do you feel about what happened to you and your family? He says, very grateful, very, very grateful. He said, if I was honest about things, I would have a shrine in my home to Idi Amin. And I remember thinking, God, is this guy a masochist? He's, no, I'm serious about this, Rick. If it wasn't for Idi Amin, I'd still be in Uganda. And as a consequence of Idi Amin, here I am in Canada. I have nothing but gratefulness. I don't like the process, but I love the product. And the final thing that he said that's always stuck with me, we were having a discussion of racism in Canada. And I know, and you know, that the myth of non-racism in Canada is ridiculous. Caucasian Canadians may be polite, but they're extremely racist, particularly racist with regards to people who work harder than them, which includes, of course, South Asians. So I said, Nash, have you ever experienced, really pernicious aspects of racism in Canada? Do people call you things? He looked at me, he smiled, he says, Rick, I'm a broker. I don't care what they call me as long as they call me. The the maturity to understand what Nash intuitively understands is that you don't allow your image of yourself to be shaped by the perceptions of people who have an interest in demeaning you, that their perceptions are just that. And if you take it seriously, you don't do any damage to them, you do damage to yourself. So this sense that Nash figured out early on that his method of success was generating utility for other people, the same lesson that I had, becoming indispensable. That in the face of suffering personal circumstances that were atrocious, that he had a sense of gratefulness. And finally, that he didn't let the perceptions of society or people who had an interest in demeaning him affect his own self-image, understanding that that was ultimately their problem, not his problem. I think makes him truly a unique human being and probably accessible to you. If I had to think of one person who would be useful in the context of your show, that it also has a lot of information to impart in the junior resource business. I mean, Nash has been insanely successful.
Well, I really appreciate his name as well as all the other names. And, I would love to get them on and unpack how they've got where they've gotten and who they are as people first, right? I always think that's the biggest thing, right? Someone as a person first. So I really appreciate that. I'll make sure to write them down. And when I have one of them on the show, I'll be sure to let you know that the episode is ready. One of my last questions I want to ask you is, where's the best place to connect with you online? And what are some of the educational and excellent conferences that you have coming up with Rule Investment Media?
You may be familiar with the fact that I put on a conference in Vancouver for years. This would be the 30th year, except for COVID restrictions. And so we're putting that conference on in Boca Raton, Florida, July 26th through 29th. Given that we've put it on for 30 years, we think we know something about high-end natural resource conferences. We have great big picture thinkers, great macro thinkers, not the kind that you see on CBC or CNBC, but the Jim Rickards, the David Stockmans, the Doug Caseys, the Nomi Prins, the Daniela DiMartino Booths, the Jim Rickards. That's important to shape the macro perspective in a way that you don't see it portrayed in popular media. More importantly, though, we have great analysts who talk about, once you've shaped your perspective, how to put it into play, how to invest, where the rubber meets the road. More importantly than that, for 30 years, we've had a group called the Living Legends, where we invite people who have built multi-billion-dollar companies from scratch in the natural resources business to talk about how they did it, what lessons they learned, and how those lessons made them a better investor and can make you a better investor. And then finally, unique among investment conferences that I know, we don't treat the exhibitors as advertisers, although we charge them. We treat them as content. In most investment conferences, the qualification to be an exhibitor is a check that cashes. That's it. You pay the fee, you're in. At our conference, your share has to be owned in a Sprott managed account or in my personal account. Sadly, that doesn't mean the stock goes up. It is not true that every stock I own goes up. But what it does mean is that these exhibitors are all vetted. We know them well enough that we've invested our own money in them. The consequence of having done the same thing for 30 years and believing that we do it well is we offer a full money-back guarantee, which I think is unparalleled in the conference business. If you come to the conference, pay the tuition, if you don't think you got your money's worth, tell me, Tell me why. I'm not going to bug you. Tell me why. Tell me what I could do better, and I'll give you your money back. 100% money back guarantee. Other than that, I, of course, have the channel that you've talked about, Rule Investment Media. I love to teach, and I think the best teaching begins with individual portfolios. So any of the listeners who go to Rule Investment Media can enter their portfolio there, their natural resource stocks. Please no pot stocks, please no crypto, please no technology, just resources. I'll rank them personally, 1 to 10, 1 being best, 10 being worst. And if I think my comments around individual issues might have some value, I'll comment on them. In addition to that, now that I'm no longer licensed, I can talk about private placement investing. It used to be that I couldn't describe private placement investments because that was soliciting. But now that I'm not soliciting anymore, anybody who cares, who is accredited, who cares what I do with my own money in private placements, can, in the comment section of the rankings database, mention placements. And I'll put you on a list where it's legal. I will describe to you what placements I've done, where I did them. That doesn't mean necessarily that you can get into the placements that I got in, but it will give you a sense of what I'm doing and why. Finally, of course, I'm celebrating retirement, turning 69 years of age by backing some guys, starting a new bank. We did this once before, the same group of people in 1999. We started an online bank called Everbank, which we grew from zero to $28 billion in AUM before we sold it to TIAA-CREF. It was a wonderful, wonderful adventure over 14 years. We frankly created several categories of financial products, which hundreds of thousands of investors took advantage of. And by the way, early investors got a 30-to-1 return over 14 years, which was not insignificant either. And so we're doing it again. After we sold our bank, the things that, from my point of view, made the bank unique were less important to the buyer. And the people who were our customers, our depositors and our borrowers, began to feel orphaned by that bank. And so we're doing it again. So anybody who cares about that, or broadly, anybody who is unsatisfied with their current banking relationships, which I suspect means all of your listeners, are invited when they come to Rule Investment Media to hear more about the bank simply by writing in the question or comment section, bank.
Awesome, Rick. Well, thanks for, just sharing with my listeners, where they could find you. Your conference, by the way, sounds awesome. I really want to make it out. I'm seeing if I could be there, but I really want to be there. Just sounds like a compelling opportunity, right? For people to learn, for people to connect.
Let me relate a couple stories from older ones. For the last 2 years, we had to do it virtually, which was fun, but there's something missing. And I'll tell you, I put my finger on what was missing. 5 years ago, 6 years ago, 7 years ago, whenever it was, I learned that I could, at a discrete distance, sometimes, follow Robert Friedland or Lucas Lundin or Ross Beatty or Bob Quartermain around the exhibit hall. See which booths they stopped in front of. See where they started taking copious notes. See where they smiled, expressed sort of fondness. See where they cut the interview short and walked away. And the idea that I could follow these superb geologists, superb entrepreneurs, superb business people, and watch them real time making investment decisions among my exhibitors was absolutely positively worth the price of admission.
Absolutely. Yeah. Well, you get that like insider knowledge, right? Which you can't get that, like you said, if it's virtual. Right. So I'm really happy that you guys are back in person. And I think you can correct me if I'm wrong. Is it your 20th year?
I believe that this will be the 28th live conference. We did 2 virtual conferences. I believe that this is my 30th year in the business.
30th. Okay. I want to thank you for all that information there at the end of where people can connect with you. I will be sure to put that in the podcast episode notes. That way people know where to find out more about the conference, where to go if they want to get their portfolio evaluated by you. And then lastly, if they want to learn more about the bank, to just comment bank in the chat. Awesome, Rick. Great. Well, I want to take this last moment to thank you for your time. You've been very generous. So thank you for being here today on Living Your Greatness.
Always a pleasure. Thank you.
Thank you for listening to the Living Your Greatness podcast. If this show has added value, please subscribe, leave a rating, and make a review. This podcast is for informational purposes only and is not to be considered personal, legal, or investment advice or a recommendation to buy or sell securities or any other product. It is based on opinions, current events, press releases, and interviews, but is not infallible. It may contain errors, and Living Your Greatness offers no inferred or explicit warranty as to the accuracy of the information presented. If personal advice is needed, consult a qualified legal, tax, or investment professional. Do not base any investment decision on the information contained on Living Your Greatness or our videos.